What's up everyone, it's Scotty with Money Investing. In this video we are going to be talking about artificial intelligence, and there were a couple of reports that I want to break down. Specifically, Bank of America Global Research Investment Team talking about how AI could potentially be a bubble moving forward. And I want to talk about in this video how I personally believe that it is not a bubble. So hope you guys enjoyed this video and find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. Link to our Discord and Patreon is going to be down below. There is a 16% discount available for under 4 more days, so you can access all of the buy and sell alerts, options alerts, trade ideas, all the private videos, all the other member benefits, including all the private live streams. So link's going to be down below if you're interested in joining us. So first things first, this right here is going to be from Bank of America Global Investment Strategy, Global Financial Data. And what they really talk about is the next bubble, artificial intelligence or AI. And these are all the technological disruptions since 1000 AD. And of course, we've got, the light bulb, the telegraph, the steam engine, we've got the telescope, the printing press, we've got social media, cell phones, World Wide Web, we've got, iPhone, Bitcoin, electric vehicles, and now they've pointed to AI, which is artificial intelligence. And they pretty much mentioned no conviction in macro narrative of 2023 means big conviction in new micro narrative of artificial intelligence. So what they're really saying is the market's pushing higher right now. We're seeing a lot of momentum. There's no real conviction in the macro of 2023, but instead there's very small micro conviction in this narrative of artificial intelligence. And then they also shared another chart going over how this is the US 10-year Treasury yield, the 10-year real rate, with respect to where inflation is. And right now what they are talking about is that 4% real yields popped the internet bubble back in 1999 and 2000. 3% popped the subprime mortgage crisis, which was back in 2007, 2008 during the real estate housing bubble. And crypto popped on real yield rip from negative 100 basis points to positive 150 basis points. In other words, crypto bubble also popped when real yields ripped from negative 1% to over 1.5% positive. But AI is still a quote baby bubble, and market telling you real rates may need to rise another 100 to 150 basis points to pop this one. And that's really where we are, right? If you really consider where the sentiment is from the markets, what I've noticed is that I think we all understand that valuations are high. I think we all understand that, chip stocks and semiconductors and AI stocks are just going crazy right now on this momentum. But everybody's just buying anyway, right? Nobody really just cares that the valuations are high. And I think that's what I've really noticed, and that's really where the sentiment is. That's really where the optimism is, that people are paying less and less attention to valuations and more attention to price action and momentum. And of course, the word AI, which obviously the more you mention, the more the stock price pretty much rallies at the moment. So there is a lot of euphoria, there is a lot of greed in this market at the moment with respect to this particular theme, this particular sector of the market. But I still don't believe that this is actually a bubble, and I'll go over my reasons why I don't believe that it is. Now, it's not to say that valuations are high. Just because I don't believe that it's a bubble doesn't mean that I don't believe the valuations are too high, because again, those are two very different things, right? Just because I believe that this is not a bubble does not mean that I believe the valuations are low, because valuations are extremely stretched. They are overvalued for some stocks. We are certainly trading at very, very expensive valuations, but I still don't believe that this is actually going to create some type of a bubble type environment. I'll go over that here in just a minute. So now this right here is another chart that they have pretty much shared, and bubbles for the few, bears for the many is what they are talking about. And America's Magnificent Seven is what they are talking about, which are going to be, of course, your Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla. Something that we've also talked about on the channel before. This is an equal weighted index that they have created. You can actually create that yourself on TradingView. And what they are talking about is America's Magnificent Seven stocks are up 70% year to date, equal weighted. The other 493 stocks in the S&P 500 up only 0.1%. Right? So just goes to show the breadth of the market, and of course how concentrated and how narrow the leadership has been with the markets. In price terms, 228 issues of the S&P are up versus 275 that are down on a year-to-date basis. So there is obviously a big divergence in this market, right? It's pretty clear. It's very logical. It is very clear. It is pretty obvious where we are with respect to these 7 stocks versus the rest of the market. and where we are with the NASDAQ as opposed to the Dow Jones and the S&P 500. So I think it's very obvious, it's very clear, but we'll get to here in just a minute. Now, shout out to Tom on Twitter for posting this. I wanted to go over, which was quite interesting, and his S&P 500 thoughts, and what he's really talking about is the market is in a bad health, and I think it is mostly going unnoticed. The S&P 500 closed at its highest level in 9 months, going back as far as August of 2022, and the NASDAQ is at 52-week highs. This headline reads like a bull market, but I'm not so certain it is. Market breadth remains atrocious. More stocks are making new lows and new highs, and this highly concentrated rally is uncharacteristic of rallies that end the bear market, and those rallies exhibit improving breadth. So what he's saying is, what's being talked about in this report is that when you do see the end of bear markets, you see a much broader base rally. That's what they really exhibit. They exhibit improving breadth. And right now we're not seeing that. We're seeing a very concentrated, very narrow leadership, which is very uncharacteristic of a ending of a bear market. Now, sentiment is fading while prices are rising in this bear market. Sentiment peaks have preceded all declines, and the AI anything vibe on Wall Street is a headline or hallmark of euphoria. In hindsight, I think this will be very obvious. For the record, I think AI tools are fascinating. And then also talking about how debt ceiling talk, rate hikes, and the Federal Reserve have tranquilized market participants. The news cycle prior was the entire coronavirus narrative and ongoing war story, and participants are numb. And I've actively shared the history shows that S&P 500 can advance. If the S&P 500 can advance 5% above its long-term moving average, 200-day exponential moving average, it is most probable that the bottom is in and a genuine market recovery is underway. But that hasn't happened yet. And the level that we need to achieve in order for that to happen is going to be 42.45. So this right here is a level. If S&P 500 next week can break past this level, that means it's going to be 5% above its long-term moving average, which is the 200 exponential moving average, and that is what's going to create this this basically technical level where there is going to be more momentum and a market recovery could very well be underway. Now, I also want to talk a little bit about my expectations. So this right here, again, 42.45 is that level to really pay attention to, and that could really spur some more momentum and break us out of that range to kick off a new bull market in this S&P 500 in this environment that we're in. So now when it comes to artificial intelligence, right, when it comes to AI, the reason why I personally don't believe that this is a significant bubble, because what I consider a bubble to be is mostly price speculation without value, right? Without value, because if there's no inherent value to the asset that's being traded and being considered as value, then if there's price speculation for that asset, that's what I consider for the most part to be very much of a bubble, right? So some of the most common and the most popular bubbles, right? If you go back to 1634 tulip mania, you've got the dot-com bubble, 1999-2000, right? That was, again, I'm going to explain here in just a minute. Real estate bubble was an exception, so I've actually put that over here. It was an exception. And this right here was, of course, the Bitcoin bubble of 2020, 2021. Now, what is very, very common among these, except for the real estate bubble that I just mentioned is an exception, is that a lot of them were actually price speculation without any value, without any inherent value. Tulip had literally no value, right? But it still went up. It was price speculation. The dot-com bubble, a lot of the companies had literally no value. They were not making any money. They were only stories, and there was no inherent value to those companies, and yet the prices of these companies were being speculated on. Now, Bitcoin, in my opinion, still doesn't have any inherent value, right? Doesn't actually have any cash flow or earnings potential, and it's only just a digital currency or like a digital asset, you can call it, that doesn't really has any inherent value, so to speak, right? But yet the price is always traded on and the price is speculated on an everyday basis. So those three things, we can make a nice correlation that there was no inherent value to these assets, and yet they were being traded as like they were the most valuable things in the world. Now, real estate bubble, the reason why that's a little bit of an exception is because if you think about it, yes, the prices of these real estate properties, like the houses, the housing market got really, really overheated. But at the end of the day, it still had value, right? It still actually was worth something, right? I mean, if you build a house, right, it's worth something, right? The woodwork, the actual appliances, the actual land, everything is worth something. But obviously, in this example, it was just overvalued, right? It was very, very overheated. So obviously, real estate prices dropped tremendously. They found a bottom. then they consolidated sideways, and now we're back up to a very, very overheated market, right? So that is an exception because it actually did have some inherent value to begin with. Even though it was very, very overvalued, it was extremely overheated, and it dropped like a rock, but then eventually it recovered because it had some inherent value. Now, the reason when you compare all those different past bubbles that I just mentioned, some of the more popular ones with artificial intelligence, the reason why I personally don't believe that this is a huge, massive bubble or anything like that is because the companies that are actually driving this innovation, driving this actual movement towards artificial intelligence are established companies with real value. Now, does that mean that they're fairly valued, or does that mean that they are perfectly trading at cheap valuations? No, they're still overvalued. They're still considered to be very, very overextended, but it isn't like they don't have no value at all, right? So I hope that makes sense, because during the dot-com bubble, when internet was a new thing, a lot of these companies were trading on stories, and they have literally no earnings potential or revenue or cash flows, and yet the prices were trading at extremely high levels. The only difference between that and now is that these companies that are actually driving the change or driving this innovation are very, very established. These are well-mature companies, profitable companies, huge cash flows, huge asset balances, right? Cash balances on their balance sheet. So these are already companies that have a lot of value built up. And everything that we're seeing now is just that overvaluation, that sentiment, that hype that's kind of taking it to a whole new level. So I mean, you could consider this as a level where, you know, we're getting way too stretched and we're overvalued, but I wouldn't necessarily label this as a bubble. Can we pull back from here? Sure. Can we see a correction from here? Maybe 10%, 20% as this starts to deflate a little bit, as the valuations come back down to earth and we get a reality check? Sure. But can we expect something like the dot-com bubble where, you know, these stocks sell off 80%, 90%, or something like Bitcoin, which also dropped over 80%, 90%, or the real estate prices dropping here? I don't think so. And the reason, again, is because the value that these companies have already created so far, they're so well established that it's kind of hard to imagine that they're going to drop like, you know, 80 to 90%, which obviously is still a possibility in the realm of all possibilities, but it's a very low probable outcome. So that's where we are, and I'm actually going to be doing a couple more videos talking about valuations, because even though I don't believe that this is a quote bubble for artificial intelligence, I do still believe the valuations are high, and that's something that we need to be taking into account, because, you know, when sentiment takes over, everything just gets disregarded. We're talking fundamentals, technicals, valuations, macros. Everything is put to bed when sentiment rules, right? But sentiment only can rule for a short period of time. Eventually, fundamentals trump sentiment over the long term. So that's something that we have to always remember, that sentiment lives for the short term, fundamentals and real value lives for the long term. So I hope you guys enjoyed this video, and let me know your thoughts on the comment section down below. And what do you think about artificial intelligence? Do you actually believe this is a bubble? For me, like I said, I think AI is the next big wave in technology. It is here to stay, and it is only going to keep growing, and it's going to be a part of our lives fairly quickly. It already is, right, to some extent. And the companies that are actually driving this change, the companies that are actually doing the innovation, are not these story companies, are not pre-revenue, no profit companies, no cash flow companies, but instead very, very mature, established, profitable companies with huge cash flows and massive cash balances on their balance sheet as well. So no, I don't expect this to be a huge bubble, but yes, valuations are something that we still need to discuss. So I hope you guys enjoyed this video, found it helpful. Make sure that you drop a like. Let me know your thoughts down in the comment section below. As always, if you enjoyed this video, find it helpful, make sure that you drop a like, subscribe to the channel. Link's gonna be down below if you're interested in joining us, and that 16% discount does expire in 4 more days. And as always, happy investing, and I'll see you all in the next video.